Okay, let's get things started. Welcome everybody. Thank you for joining today's webinar where we're going to be looking at global land drilling rig market outlook. This session is based off our latest annual report, and indeed I'm about to introduce the team who are going to speak through some of the key conclusions from that. Everything we show you today is derived from the report. You can find more information about that on the Westwood energy.com website, but we'll provide you with some links as we go through. So just to jump back a couple of slides there, Ben, just before we get to your good self, all about you. It's been some time since we've done a session on land rigs, so just a quick recap in terms of Westwood's coverage of the energy market. This will be available within the deck afterwards, but today obviously we're going to be looking at onshore energy services and specifically the land rig market. But more broadly, we do cover the upstream life cycle from E&P, from E&A, through to the new development of the new energies team here with energy transition, which of course runs through everything as a theme, and of course offshore, where we do offshore rigs through Rig Logics. But as I say, today we're going to be focused on the global land rig solution and the report, which is an online application for data analysis, which we supplement with access to two very fine gentlemen I'm going to introduce in just a moment. That being said, of course, if you need something more bespoke, we have a really strong consultancy team, particularly on the onshore side of things that we've been doing for many years. So do please get in touch if you have something more specific. Next slide, please, Ben. And as I just touched on, in terms of the coverage, we've got North American unconventional, so energy product, global land rigs for the international land rig side. And again, more broadly, if we're looking at specific areas of components and equipment, we can also go down to quite a fine degree in terms of looking at sort of individual forecasts and how they manifest into projects. So on the call, Todd Jensen, who's in our London office, as in Ben will be, and Todd and Ben are our dynamic duo, specifically looking at land rigs today, but also the broader onshore market. First up, I believe, is going to be Ben, and then we'll be followed by Todd. In terms of asking questions today, those of you who are familiar, which I'm sure is everybody by now with Zoom, at the bottom of your screen there is a Q&A button. Please feel free to submit your questions via there. Once we get to the end of today's session, we'll have a run through. And there will also be opportunity to stay on. We'll run a short poll when we get to Q&A to have a look at the solution, have a look at some of the data and give you a chance to interrogate it that way. So enough from me. Ben, if I'd like to hand over to yourself, and we'll go from there. Enjoy the session, everybody.
Brilliant. Thank you, Gareth. So we're going to start this year's webinar just looking at the agenda. We're going to start by looking at the macro environment we find ourselves in currently. As you can imagine, it's a very different place than when we did this webinar about, I think, last September. Following this, we'll get into what is the real meat of the webinar, looking at the global market outlook for land rigs, as well as going into more depth on a selection of countries, including Argentina, China, the US, and then a kind of overall look at the GCC region. We'll then look at the day rates land rigs are currently able to achieve in a series of markets and how this is already being recognised in land rig company revenues, before a quick Q&A session followed by a demonstration of the actual global land rigs tool. So when we look at the macro environment we find ourselves in now, as I said, it's completely different from that of a year ago. Russia's invasion of Ukraine has seen commodity prices rapidly accelerate, and Brent actually peaked at around $123 on average in June. In the last quarter, there has been something of a retreat in pricing from this high point, with September oil prices averaging $90. This decline is a result of growing fears of recession, as well as a strong dollar and ongoing concerns over demand in China. The OPEC Plus group, of which Russia is a member, have responded quite strongly to this slight downturn in oil prices, revising their production cut announcements, which were initially expected to finish in September and then are going to continue to the foreseeable future. The group's output was cut back to August 22 levels in October after a slight increase was allowed in September. But a more aggressive cut of about 2 million barrels a day on August levels was announced for November. And that's what you can see on the table in this slide. The longer term effects of this have yet to be seen, but really it's had quite a limited effect on oil prices since its announcement. And whether it will be enough to support current oil prices long term if sort of everything else stays as it is, which it seems unlikely at the moment, but were that to be the case, whether this will be enough to support those current oil prices yet to be determined. Given the group as a whole has consistently underproduced, and I think it's closer to 40 million, 41 million barrels. And these cuts are likely only really to impact Saudi Arabia, the UAE, and Kuwait, which are the ones that are really pushing against their quota agreements. As we'll discuss in more depth later, the Middle East is a key region for land rig activity, making output cuts such as this a major potential threat to overall drilling activity. The key Middle Eastern producers, such as Saudi Arabia and the UAE, however, are known for their long-term strategic planning, and their production capacity targets, I think 2027, 2030 targets, are a key driver of land rig activity over the forecast period, and they still appear to be moving forward. And that's highlighted clearly by the raft of contract awards that has continued even as these OPEC plus cuts, quotas have continued to be in place. So the change in oil price is just one of the effects of Russia's invasion. The conflict has also reignited concerns over supply and chiefly around the security of that supply and diversifying it. And it's these concerns, which relate both to oil and gas, that are likely to drive much of the forecasted activity, spurring investment into areas that have either previously been considered uneconomic, but also allowing those key producers to increase production above earlier expectations. Previously shelved pipeline projects, such as the Trans-Saharan gas pipeline, have been brought back into the conversation, having laid dormant for several years. While that pipeline in particular may not ever come to fruition, it is a clear sign there are numerous countries and companies rushing to fill the gap that has been left by Russia. And now we're going to look at a couple of metrics that kind of just highlight the improvement of the oil and gas industry this year. So we look at the CapEx guidance for a series of companies, and coming into 2022, generally there was an expectation for increased CapEx spend in 2022 when compared to 2021, with improved market conditions anticipated. As the year has progressed, the majority of companies in the select groups have raised their CapEx up from these initial expectations. And that's a reflection of both the heightened desire to increase investment, but also an indication of the inflationary cost pressures that have been a feature of 2022 activity. The majority of oilfield services, which were relatively flat cost-wise in 2021, have seen quite rapid increases in 2022 as shortages and rising demand drove pricing up quickly. And Todd will be detailing how this is impacting day rates in particular later in the presentation. One crucial feature we've seen from many of the company's financial reports this year has been an acknowledgement of this rapid price inflation and a desire to increase capital to support ongoing projects without causing prices to rise too high, something that was a feature of the industry in the early 2010s. And it's here that we see that desire for capital discipline and a focus on shareholder returns rather than direct production growth still being a key driver of company policy. That's specific to those companies, the IOCs and independents. National oil companies, the picture is slightly different. So overall, when we look at the sort of CapEx guidance, it's changed from about $77 billion in 2021, $91 billion at the start of the year, and it's now increased to about $103 billion. So some companies, such as Woodside, we've seen almost 100% increase on those 2021 levels. When we look at people like Total Energies as well, this isn't just a 2022 revision, they've revised their CapEx for the next few years. So we're going to look at probably the most reactive market to this oil price change, which is, of course, the US lower 48. And that really has seen a strong recovery in 2022. Companies with large acreages in the shale plays have revised their drilling campaigns to allow for sort of extra production to meet demand. As a result, the number of rigs expected to be drilling in the lower 48 in 2022 has risen well above that of 2021, of about 627 rigs on average expected, compared to 423 in 2021. However, issues with the supply of crews to complete the operations and shortages of some materials, including cement and sand, have put somewhat of a limit on how much growth has been possible. As you can see from the chart on the right, the Permian it's been a clear focal point historically, and that's going to continue over the rest of this year into next year. We expect about 338 rigs on average this year, and about 400 rigs into next year. Highlighting the importance of this basin, many of these companies, Oxy have announced their reallocation of about $200 million of their capex spend for the year just to the Permian Basin, as well as relocating a rig from another shale play to that play. When we look at some of the other things, other shale plays, the Haynesville area is meant to have strong, steady growth throughout the forecast period. However, the Appalachia area is currently hamstrung by delays to additional pipeline capacity being brought on. And so this is something that could become a more widespread problem in other basins later in the forecast period. So when we look at what this activity is actually translating into, it's caused quite a quick surge in production. If we take the last month of EIA data, sort of known data, which is July of this year, we find that production is about 11.71 million barrels a day. It's about 20% higher than the low point seen under COVID-19. And the forecast expectation for this is to grow consistently into next year, surpassing that of January 2020 by November 2023. Now we're going to move on to the sort of bulk of the presentation, to look at where the land rig market currently is and where we expect it to go over the next few years. Before I hand over to Todd, I'd just like to go over the kind of sort of key definitions that underline what he's going to be discussing. It's important to say that when this is our expectations for the global land drilling rig market. As a result, workover rigs are not included, and our wells drilled forecasts, which are sort of the underlying driver of this, track onshore development and E&A wells, but don't include sidetrack or workover wells. Our capable rig fleet, which is our sort of supply, that's our sort of view of the total number of drilling capable rigs in that particular market. So if we're talking about globally, it's globally. If we're talking about China, it's the current number of rigs that are located in China and able to work. We do have that changing going forward, but we tend to assume that most of the markets will be relatively stable with sort of slight improvements or slight declines. It's very rare you see a marked change in supply. We then look at rigs operational, which is our sort of demand forecast. And this is the average number of rigs in a given year that are either drilling or mobilizing to a field. And that number is built up based on our wells drilled forecast. So we look at the number of wells to be drilled, and we kind of calculate how many rigs will be required. And that depends on sort of the historic amount in a country, as well as what we expect to happen to sort of the amount of footage that is required to be drilled per well, things like that. And that kind of gets us to our utilization, which is the average proportion of the capable rig fleet that is operational. So with that being said, I'm going to hand you over now to Todd to go through the market forecast.
Thank you very much, Ben. I will now take you through the current land rig market and what we expect to see over our 5-year forecast. I will start off by going over the global market outlook, and this will be followed by a regional comparison before we focus in on some of the key countries and share some of Westwood's latest day rate data. So if we look at the global market first, with oil prices holding around $100 a barrel in the first half of 2022, a lot of the immediate concerns for the onshore industry following the impact of the COVID-19 pandemic and oil price downturn were alleviated. However, we do expect a modest increase in drilling activity rather than an instant return to 2019 levels due to instability within the market, particularly surrounding oil and gas prices following the ongoing war with Russia and Ukraine, and also the subsequent sanctions from the West on the Russian hydrocarbon industry. Westwood expects 49,600 wells to be drilled during 2022, boosting the number of rigs operational up to 4,070, which is up from 3,820 in 2021. So this will see utilization increase 2% to 45%. Year-on-year growth is then expected to occur throughout the forecast, reaching nearly 60,000 wells drilled in 2026, with rig demand hitting just over 5,000 rigs globally. Utilization rates are forecast to increase 8% to 53% over the forecast period. However, it is likely that utilization for the higher horsepower rigs will be considerably more than the low horsepower rigs. And I will go into some of the reasons behind that a bit later on when we look into some of the key countries. Key drivers of forecast activity include China, GCC countries in the Middle East, and also Russia. The war in Ukraine has dramatically affected Russia's drilling outlook, which represented 14% of global wells drilled in 2021, and Westwood expects this to drop to 11% in 2022. As we move on to look at the regional variances, we can see in the pie chart on the left that the illustration shows the split in the total number of wells drilled over the forecast periods. It is clear that drilling and therefore rig demand is driven by North America, Asia Pacific, and Eastern Europe and FSU regions. These regions are expected to account for 88% of the total number of wells drilled over the forecast and 80% of rig demand. Asia Pacific is expected to have the greatest utilization over the forecast, with rates of 67% over 2022, increasing to 76% by the end of the forecast. North America leads the way for the number of wells drilled, however, is the second largest region for rig demand behind Asia Pacific. And this is due to the sort of types of drilling that we are seeing within the key countries within these regions. And again, I will go into more detail when I move on to the US and China slides a bit later on. The vast majority of Asia Pac is expected to come from China. And some countries such as India, where there is a sustained drive to increase domestic production, and also Australia, which will also be a potential bright spot over the forecast. Eastern Europe and FSU is expected to be the third largest region for demand, dropping down from second last year in the wake of Russia's war in Ukraine. Activity in the region is driven largely by Russia, where drilling levels are now expected to drop significantly as a result of ongoing events and subsequent sanctions from the West. A number of majors have divested assets in Russia. Shell has exited its joint ventures with Gazprom. BP sold its 19.75% stake in Rosneft, and Equinor also announced plans to offload its Russian assets. As a result of this and the subsequent sanctions and the removal of capital investment provided by super majors, Westwood expects that activity will be stymied throughout the forecast. A contraction has already been seen, and Westwood forecasts that an estimated 4,600 wells will be drilled in 2022, which is 28% lower than levels seen in 2021. So quite a significant drop off this year. We expect this to continue to drop into 2023 before a potential slight improvement through to 2026, with rig utilization expected to hover around the 50% mark throughout the forecast period. Considering this conflict is still ongoing and there's no knowing when it's going to be resolved, the future of activity in Russia remains uncertain for the foreseeable future. However, with increased exports to Asia, Russia is still likely to play a key role within the global market. And the country is expected to rely heavily on NOCs, particularly Rosneft and Gazprom. Rosneft has a substantial rig fleet within Russia, so it should be able to support drilling to a pretty complete extent. The only other country with a high level of drilling activity in Eastern Europe and FSU region is Kazakhstan. Kazakhstan is expected to continue to improve drilling levels over the forecast period. This will be supported by the 10 years expansion project coming on stream in the first half of 2014. North America has continued to recover strongly from the downturn of 2020. Over the forecast, the number of rigs operational in Northern America is expected to continue to grow year on year, while any supply chains within the rig fleet are expected to be marginal, with drilling contractors preferring reactivations to rebuild. I will be covering this in more details in the country focus slides. So as we start to, as we start to focus on the key countries, I will start off by looking into China in more detail. China is the leader of rig demand over the forecast period, and Westwood has an identified rig fleet of 1,524 units within the country. This fleet is dominated by NOCs, CNPC and Sinopec, who account for a combined 95% of the total rig fleet within China. A relatively high proportion of the fleet is low horsepower rigs, with 65% of the identified fleet equipped with drawworks rated below 1,500 horsepower. However, Westwood does expect to see an increase in a proportion of 1,500 horsepower plus rigs in the fleet over the forecast as the country aims to develop its unconventional resources, as well as maintain production from its existing maturing fields. China's unconventional shale gas is largely at significant depths, with Sinopec's discoveries within the southeastern Sichuan Basin having an average total depth of over 3.5 kilometers. While PetroChina has recently set a record with the Shuangyu 1H6 onshore gas well in June 2022, which reached a measured depth of 9,010 meters. Chinese government concerns over energy security has driven drilling rates in China as increasing domestic production became the key focus. This has led to an expected 14,780 wells to be drilled in 2022. With these government mandates in place, we are looking to see an increase in production being vital to drilling activity over the forecast, with NOCs aided by government subsidies investing substantially into projects which have previously been considered financially unviable. So the commodity prices are definitely helping some of these projects within China become worthwhile. Much of the drilling activity seen in 2018 has taken place at mature fields that have been considered unfavorable due to costs in the past. The drilling at the mature fields is expected to continue throughout the forecast. However, it is the shale gas drilling that is expected to lead the way and drive the drilling rates within China, with PetroChina expecting 60% of China's gas demand to be met by unconventional resources by 2026. Post 2022, Westwood expects overall onshore drilling activity to grow year on year within China, albeit at a relatively small rate of just 2% per year through until 2026. As a result of this, we expect 1,440 rigs to be required for drilling at the end of the forecast, over 200 more than we are seeing at present. This is expected to boost utilization up to 89% by the end of the forecast, while both low horsepower and high horsepower rigs are expected to see growth in the number of rigs drilling over the forecast. High horsepower rigs will lead this with 23% more high spec rigs drilling in 2026 compared to this year. So as I previously mentioned, we're expecting to see the higher spec equipment really sort of take over and become the sort of standard requirement for the activity in these countries due to the type of drilling that they're doing and the depths that they're needing to get to. There is also significant upside potential in China over the forecast. While commodity pricing will have some impact on this, the speed at which many of the ambitious production targets can be reached will depend on continued positive exploration and appraisal results at key shale gas basins. Significant infrastructure development will also be required to support any large-scale development projects. So the speed at which major construction contracts can be approved, sanctioned, and then completed will very much determine the speed at which the number of wells drilled can increase. Next up are the GCC countries. These are the 6 countries of the Gulf Cooperation Council. Of the 6, today I'm going to focus just on 4. These will be Kuwait, Oman, Saudi Arabia, and UAE. These are the ones that have the significant demand for onshore rigs out of the 6 countries. The GCC countries have a combined identified rig fleet of 555 units, with 2022 rig demand expected to be just over 300 rigs. Westwood forecasts this number to reach 400 by 2026, with utilization rates expecting to increase from 60% to 64% over the forecast period. This relatively small increase in utilization rates is due to the fact that NOCs in the GCC countries are investing heavily in onshore rigs and significantly increasing the sizes of rig fleets over the coming years. The overall fleet is expected to grow by 130 rigs over the forecast periods, and this will be driven heavily by ADNOC, Saudi Aramco, and Kuwait Oil Company. Excuse me. ADNOC has plans to acquire dozens of rigs by 2025, including land, island, and offshore rigs. They're doing a very good job. It's incredibly hard to keep up with their rig fleet, so I do appreciate the challenge. Saudi Aramco Nabourj Drilling Company, also known as Sanad, has received and successfully drilled the first well with the first of 50 locally sourced, newly constructed rigs, which it is set to receive over the next 10 years. And the Kuwait Oil Company has also tendered for the manufacturing of 44 drilling rigs, 24 of which will be 1,500 horsepower to 2,000 horsepower, and 20 of which will be 750 horsepower units. Kuwait is expected to be one of the strongest countries within the region for drilling over the forecast, with significant year-on-year growth expected. A number of the key projects expected to progress to supporting drilling activity, with demand for high-spec rigs expected to grow particularly strong as new fields are developed. This includes development of the country's heavy oil fields and the continued development of the Jurassic gas project. Kuwait is expected to focus on stemming declining production at its mature fields, including the large Burgan oil field, which will require a substantial number of wells to be drilled in order to maintain current production levels. 2022 activity in Kuwait is expected to see 452 wells drilled, which is an 8% increase on 2021 numbers. This will see the rigs operational increase to 55 units, which is a 5-unit increase on 2021. Whilst increased drilling will help rig demand, utilization rates will be relatively low in comparison to the Kuwait Oil Company brings the recently tendered rigs into the country's fleet. In terms of these tenders, manufacturers were allowed to bid for a supply of up to 8 rigs, and these rigs have to be supplied within 5 years. The new rigs will support Kuwait's target of increasing its production capacity to 3.2 million barrels per day by 2025, and then on to 4 million barrels per day by 2040. Oman, as we move on to look at Oman accounts for the largest volume of onshore wells drilled in the GCC region due to market characterized by low productivity wells compared to regional benchmarks. 2022 has so far seen strong recovery compared to the previous 2 years, driven by the need to prevent production decline by drilling high numbers of wells. Westwood expects 980 wells to be drilled in 2022, up 10% on 2021 levels, with the number of operational rigs reaching 79. Utilization, which has historically been in the region of 75%, is expected to reach over 75% this year and remain above this level for the remainder of the forecast. Activity is expected again to increase year on year, reaching a peak of 1,100 wells drilled in 2026. And as a result of this, rigs operational are expected to reach 92 units, with utilization hitting over 80%. Saudi Arabia is one of the largest producers of liquids, and as a leading member of OPEC has accounted for a large share of the group's voluntary production cuts since cuts began. As a result of this, activity levels in recent years have been somewhat curtailed by need to comply with restrictions. Westwood expects a ramp up in drilling in 2022, which is expected to continue throughout the forecast periods as attention turns from output restrictions to reaching their 13 million barrels per day production capacity target by 2030. This has already begun to be seen, with the number of wells drilled this year expected to reach in the region of 400, which is 37% higher than seen in 2021. This will see rigs operational increase from 89 in 2021 to 124 in 2022. This growth is expected to be maintained throughout the forecast period, with 567 wells expected to be drilled in 2026 at the end of the forecast period. This will see utilization rates increase to 78%, up from 61% this year. With the country's drive to increase production capacity and maintain its position as one of the leading producers globally, there is potential for a number of wells to be drilled to be above the expectations, depending on future OPEC production adjustments. But as things stand, it looks like Saudi Arabia is able to keep on drilling at its increased rate without affecting its OPEC target. In the UAE, drilling activity in 2022 has been strong so far, albeit not back to the level of 2019, and is expected to stay strong throughout the rest of the year, with 325 wells drilled and 65 rigs operational. Westwood expects the UAE to increase drilling rates throughout the forecast period as they look to increase production capacity to 5 million barrels by 2030. ADNOC has indicated that it is planning to acquire dozens of additional land, island, and offshore rigs by 2025, as I previously mentioned, and this will impact utilization rate increases. So whilst Westwood forecasts that 325 wells drilled in 2022 will increase at an average rate of 9% a year, which will lead to 450 wells drilled in 2026, rigs operational are expected to reach 95 by the end of the forecast, with utilization expected to be around 75%. As we move on to look at the US, there is a large rig fleet within the US with an estimated 260 units currently. The land drilling rig market in the US is highly competitive and fragmented, with a large number of well-established international and indigenous contractors having rigs available within the country. The US rig market has seen its fair share of ups and downs over the last few years. The capital discipline era preventing drilling activity and rig demand from reaching the levels seen in 2014, and then steep declines in drilling activity and rig demands due to COVID-19 in 2020. During 2021 and into 2022, the US market has recovered well, buoyed on by high commodity prices. Westwood expects to see a 26% increase in the number of onshore wells drilled in 2022 compared to 2021. As a result, excuse me, I'm just going to get some water. As a result, the average number of rigs operational in the US is expected to increase from 680 units in 2021 to 860 units in 2022, as the demand and drilling numbers steadily increase. This is expected to lead to utilization rates of 42% in 2022, well above the 33% seen last year. Year-on-year growth is expected throughout the forecast period, and by 2026, the number of wells drilled and subsequently rig demand is expected to be above pre-pandemic levels. Wells drilled are expected to increase by 40% over the forecast period, reaching 20,150 wells by 2026, similar to the number drilled in 2018, pre-pandemic. The number of rigs operational will subsequently rise to 1,180, and utilization will grow as a result, reaching 57% in 2026. Whilst we expect there to be the abundant supply of rigs given the level of demand, many operators in the US prefer high-end super spec rigs, of which there is less than 140 available. Due to the demand for these super spec rigs, such units are now fetching day rates in the mid 30,000 range. So we're now seeing a lot of contractors within the US upgrading the medium spec rigs. So instead of spending the substantial sums to have new high spec rigs built, we are seeing a significant number of rigs being upgraded across the board. Moving on to Argentina. So Argentina is a new addition into this year's webinar, and I personally think it's quite a fascinating country to look into. So in 2021, Argentina recovered well from the economic problems and effects of COVID-19 restrictions in 2020. Last year, we saw 850 wells drilled, which is 92% up on the 443 drilled in 2020. The average number of rigs operational within the country increased to 70 rigs from an average of 38 in 2019, which saw utilization increase from 25% to 50% within a single year. YPF is investing heavily in shale projects and has significantly increased the speed of drilling and fracking in the Vaca Muerta shale formation, completing 138 wells in 2021. The efforts of the government should help growth continue post-2022, with the strong increase in expected wells drilled in 2022 forecast to continue throughout the forecast period up until 2026. Westwood expects 1,000 wells to be drilled in 2022 and is forecasting year-on-year growth throughout the forecast, with wells drilled expecting to reach just over 1,200 wells by 2026. The number of rigs operational is expected to grow from 80 this year to 100 by the end of the forecast, with utilization increasing from 59% up to 71%. There is substantial upside potential within Argentina. Should commodity prices remain elevated, the investment from national oil company YPF is likely to be ramped up alongside greater levels of investment from other international companies operating within the Vaca Muerta. However, even in a positive oil price environment, concerns over infrastructure and the supply of relevant materials such as frac sand are expected to put a limit on growth over the forecast period. Argentina has also recently changed its financial system. So it's basically changed the way that operators are allowed to handle their money within the country and how they are allowed to manipulate, or not manipulate, but how they're allowed to utilize their profits, should I say, in terms of pulling money out of the country to invest elsewhere. So moving on to our latest data set, which is a new addition to this year's annual onshore market forecast. We are going to look into our day rates. So this year's report and Westwood's global land rig tool now cover day rates ranges from 40 countries across the globe. And we have new data being added all the time. So it's not just 40 countries and it's never going to change. It's the data that we already have is reviewed on a regular basis. And I am constantly trying to build out this data set until it will be a global data set. And I'm currently working on the next region. So over the course of 2022, since the increase of commodity prices, the prices of materials used in drilling have risen significantly. And this has led to several questions around how day rates are moving in comparison. And the answer is there is no one-fits-all answer. So Northern America has been the most reactive to the oil price increase, with contractors recently announcing a 25% and a 35% increase in land drilling day rates in the US and Canada, respectively. As I've previously mentioned, the tier 1 rigs in the US are now fetching day rates up into the mid 30,000s, which is significantly higher than the numbers we were seeing towards the end of last year and even in Q1 this year. So in Q2 announcement, many contractors announced in their financial reports their average daily rig revenues were in the region of $26,500 per day. And this is up from levels of $23,000 to $24,000 per day in Q1. So we're seeing quite a significant increase in day rates over a very short period of time. And with the high spot prices for the rigs and drilling equipment, contractors in the US are looking to keep contracts short, allowing them to maximize revenues, whilst commodity prices remain high. In the Middle East and North Africa, we see a very different story. So we see that day rates vary significantly within the region, especially across the Middle East compared to North Africa. So the GCC countries tend to demand higher day rates than elsewhere in the region, particularly due to demand and also the level of rigs that they have available. So in the GCC countries, we see some of the sort of very high spec industry leading equipment, whereas in places such as some of the countries in North Africa, we see fluctuating day rates because the level of the equipment available varies significantly. And also in the Middle East, the long-term contracts means there is less variation in day rates over time, as most contracts are fixed for at least 5 years normally. And we do see quite a lot of extensions in the region of 10 years as well. So these rigs have really been tied down for a long time. And it doesn't always offer the contractors a significant amount of wiggle room in terms of pricing. So contracts in the GCC are also focused heavily on health and safety and past performance. And this makes it very hard for new contractors to enter the market. NOCs also tend to own a significant proportion of the rigs and can therefore dictate the day rates. Prime examples of this are Saudi Aramco with their Saudi Arabian Boers drilling company, and also ADNOC with ADNOC Drilling, who own a significant part of the rig fleets within those countries. And they will always prioritize using their own rigs over the rigs of international contractors, which makes sense from a financial perspective. In Kuwait, we have seen some of the smaller contractors drive very competitive rates as they strive to win the contracts and enter the new contracts before the new rigs that Kuwait Oil Company have ordered enter the market. Latin America, we see slightly lower day rates and on average than in the Middle East. And we again see little movement since the oil price has increased, with contractors holding prices steady due to contractual obligations and a loyal client base. So average rates for high spec units in Latin America are between $28,000 to $34,000 per day. However, in countries such as Colombia, the state-of-the-art joystick equipment can achieve rates of up to $40,000 per day. Some of the countries that host smaller fleets, such as Peru and Paraguay, we see day rates significantly lower due to less demand and also lower spec equipment available. So in Peru, we see somewhere around the $20,000 to $28,000 mark for their equipment, and in Paraguay it's $16,000 to $25,000 because they host no high spec equipment. So we've also seen Chinese contractors remaining extremely competitive on prices, especially over the last year. So in a couple of few countries across the world, they are pushing down the day rates in order to win contracts and are very much bucking the trend of the increasing prices within the drilling sector. So in terms of the methodology behind the day rates, I have spent a significant amount of time running consultations with the drilling contractors and operators across all of the regions that we have day rates for to date. I collate all of the responses I get, and we take into account, so we separate our rigs up based on horsepower primarily, and then we also take into account the equipment that is on the rig. So we look at the top drives, the draw works, whether it has the walking ability on the pad. So we take into account all of those features, and then we use those to narrow down the range of day rates that the rig would be able to achieve. So if it's a very high powered rig with walking ability, it's going to be pushing the top end of the range. Whereas if it's a lower powered rig with very old equipment on it and hasn't been maintained particularly well, for example, then obviously it's going to be reaching the very bottom of the day rate ranges that we have. So we do split the ranges are also split. So when I'm doing my research, I'm not just asking for day rate ranges for general rigs. I do ask very specific questions on what the horsepower of the rig is, and then come up with individual ranges for each spec category. So if you would like to know more information about the methodology as well, we do have a day rates white paper, which will be available via our website. If you are unable to find it, please feel free to reach out to myself or Ben, and we will be happy to help you out. I will now hand back over to Ben, who will take you through rig contractor revenues and key messages.
Yeah, thank you, Todd. So just looking at this, a combination of these day rates and the significant uptick in activity has already translated into quite dramatic improvements in revenues for rig contractors. Before we get into discussing just how much of an improvement there has been, it's worth highlighting that revenue for the selected companies included here has yet to actually return to the level seen at the start of 2019. So from the 11 companies featured, revenue for Q1 2019 totaled about 2.2 billion. In comparison, spending Q2 2022 is about 1.9 billion. So it's worth remembering that things aren't quite yet back to the level they have been in the past. And 2019 was by no means a banner year for land rig revenues in itself. However, what is clear is that revenues are certainly trending in the right direction. Just looking at this year, the difference in revenue is clear. Of the selected group we've got here, revenues have increased by an average of about 15% in Q2 2022 when you compare that to Q1 2022. So in just one quarter, we've seen 15% increase. For context, in 2021, over the same quarters, the increase was 3%. When we look at Q2 2022 and we compare that to a year ago, it's increased by about 56% in a single year. And that's significantly more than the jump that was seen between 2020 and 2021. And expectations for the rest of the year from these contractors are generally strong and above what their expectations were coming into 2022. And while the market remains in a state of major flux, as our forecast shows, the expectation is for another year of increased drilling activity, which should translate into higher day rates and subsequently higher revenues for those rig contractors. So looking at the key messages, I think the key message is quite clear. It's the activity in drilling activity is recovering, and it's been above our expectations so far, growing by about 12.7%. Over the forecast, we're expecting that growth to continue. However, globally, there is still that persistent oversupply of rigs, and that is forecast to continue. As a result, it's only increasing from about 45% to 53% utilization. Regionally, Asia Pacific, Eastern Europe and FSU, North America accounting for about 80% of average global rig demand. So there's not a huge change in that compared to the kind of past 5 years. It's just that within those markets, for example, the United States takes up a less of a portion than it did before. China takes up a larger one. Utilization levels in certain areas, such as China and the key GCC countries, are expected to be well above of our sort of overall forecast numbers. And it's worth highlighting as well, the US, despite seeing relatively low utilization, the high HP, more than 2,000 sort of tier 1 categories are expected to be quite tight and squeezed. So we should see day rates in those regions ramp up quite a lot. And as we kind of see there, day rates in North America risen significantly among the high commodity prices, which is translating into strong revenues for rig contractors. MENA and Latin American regions have seen smaller growth, and that's more a function of their markets. So it'd be interesting to see what happens when rigs come up for retender there. Now we're going to get everyone back to do a quick Q&A session.